Meet Jessica. At 25, she was making $45,000 a year as a teacher, barely scraping by on student loans and rent. But Jessica made one decision that changed everything. She invested $6,000 in her Roth IRA using a simple strategy I'm about to share with you. By age 65, Jessica had accumulated $1.2 million, completely tax-free. Here's the crazy part. Most people are losing thousands of dollars every year to taxes on their investments, money that could be growing and compounding for decades. But what if I told you there's a completely legal way to never pay taxes on your investment gains again? Today, I'm revealing the exact 6 ETFs that could transform your Roth IRA into a tax-free money machine, the same strategy Jessica used to build her $1 million retirement. What's more expensive? 2 seconds to hit like, or missing 40 years of tax-free growth? Hit like and subscribe so you never miss out. But first, let me tell you why Jessica's strategy worked so brilliantly. The Roth IRA is hands down one of the most powerful wealth-building tools available to everyday investors. Here's how it works. You contribute money that you've already paid taxes on. But here's the magic. Everything that money earns from that point forward is completely tax-free. We're talking about all your capital gains, all your dividends, all your compound growth. None of it gets touched by the IRS. Let me put this in perspective for you. If you invest $100,000 in a regular taxable account and it grows to $500,000 over 20 years, you could owe tens of thousands in taxes when you sell. But in a Roth IRA, that entire $400,000 gain is yours to keep. The government can't touch it. And here's another incredible benefit. You can pass this tax-free wealth down to your children. They inherit it completely tax-free and can continue growing it for their entire lives. Plus, if you ever need access to your contributions, you can withdraw 100% of what you originally put in at any time with no taxes or penalties. For 2025, you can contribute up to $7,000 if you're under 50 and $8,000 if you're 50 or older. The only catch is you need to wait until age 59 and a half to withdraw your earnings tax-free, and you need to have held the account for at least 5 years. Break those rules and you'll face a 10% penalty on your earnings. Now, let me show you exactly how Jessica built her fortune, starting with the foundation of her entire strategy. Jessica's first move was building an unshakable foundation with what I call the Swiss Army knife of investing, the broad market ETF. This was the cornerstone of her entire portfolio. Now, when it comes to broad market ETFs, you've got some incredible options to choose from. There's VOO, which tracks the S&P 500, SCHB, which covers the entire US stock market, SPLG, which is another S&P 500 tracker with ultra-low fees, SPY, which is the granddaddy of all ETFs, IVV, which offers rock-solid S&P 500 exposure, ITOT, which gives you total market coverage, and VT, which goes global with international exposure. But the broad market ETF Jessica chose was VTI, the Vanguard Total Stock Market ETF. And here's why this was her perfect choice. This single fund gave her exposure to 3,555 different stocks across the entire US stock market. We're talking about giants like Microsoft, Nvidia, Apple, Google, and Berkshire Hathaway, plus thousands of other companies spanning every sector of the economy. The beauty of VTI is that it's incredibly diversified across technology, consumer discretionary, industrials, financials, and every other major sector, which means Jessica wasn't betting on just one part of the market. This diversification helped protect her from the ups and downs of any single industry or company. VTI has delivered consistent returns of 12.9% annually over the past 10 years, and an impressive 15.85% over the last 5 years. Plus, it pays a dividend yield of 1.2% quarterly, giving Jessica regular income that was completely tax-free in her Roth IRA. And here's the best part. This incredible diversification and performance comes with an expense ratio of just 0.03%. Meaning Jessica paid only $3 for every $10,000 she invested. This broad market foundation gave Jessica steady, reliable growth while spreading her risk across thousands of companies. Once Jessica had her market coverage locked down, she was ready to add rocket fuel to her portfolio. This is where the growth ETF comes in. Jessica understood that she had decades for her money to compound, and she wanted to maximize that potential. Now, the growth ETF universe is packed with powerhouse options that could supercharge your returns. You've got VUG, which focuses on large-cap growth companies, SPYG, which gives you S&P 500 growth exposure, IWF, which targets Russell 1000 growth stocks, QUQQ, which concentrates on the tech-heavy NASDAQ 100, and MGK, which offers mega-cap growth potential. But the growth ETF Jessica chose was SCHG, the Charles Schwab U.S. Large Cap Growth ETF, and this choice was pure genius. This fund focuses on companies that are rapidly scaling their businesses and are expected to grow their market share and revenues faster than the overall market. SCHG holds 231 stocks, with heavy concentrations in the companies driving our economy forward: NVIDIA, Microsoft, Apple, Amazon, and Google. Because these are growth-focused companies, the fund is heavily weighted toward technology, communication services, and consumer discretionary sectors. Here's where it gets exciting. SCHG has delivered annual returns of 16.7% over the past 10 years and over 18% in the last 5 years. When you compare that to the overall market returns, growth has significantly outperformed, helping Jessica accelerate her wealth building. The expense ratio is incredibly low at just 0.04%, costing only $4 for every $10,000 invested. Now, I need to be honest with you. This higher growth potential comes with higher volatility. Growth stocks can swing up and down more dramatically than the broader market. But for someone like Jessica, who had 40 years until retirement, this volatility actually worked in her favor. She could ride out the short-term fluctuations and benefit from the long-term upward trajectory of innovative growing companies. By age 35, Jessica wanted something else in her portfolio: passive income flowing in every quarter. This is where the dividend ETF became her secret weapon. When it comes to dividend ETFs, you're spoiled for choice with some truly stellar options. There's SCHD, which focuses on high-quality dividend stocks, VIG, which targets dividend growth companies, DGRO, which emphasizes rising dividends, VYM, which offers high dividend yields, DGRW, which combines dividend growth with quality, HDV, which concentrates on high dividend value stocks, and DIVB, which provides diversified dividend exposure. But the dividend ETF Jessica added was FDVV, the Fidelity High Dividend ETF, and this was a masterstroke for her tax-free income strategy. This fund holds 123 companies that not only grow in value but also pay out a portion of their profits directly to shareholders. We're talking about established, profitable companies like NVIDIA, Microsoft, JP Morgan, Visa, and Coca-Cola. The magic of dividend ETFs in a Roth IRA is that all this income is completely tax-free. FDVV pays out a solid 3% dividend yield quarterly, which means Jessica was receiving $3,000 in annual dividend income for every $100,000 she had invested, all tax-free. But here's what made FDVV special. It wasn't just about the income. This fund has also delivered strong total returns of 12.64% annually since its inception in 2016 and 17.84% over the last 5 years. Jessica was getting the best of both worlds, growing capital and steady income. The expense ratio of 0.16% is still very reasonable, costing just $16 for every $10,000 invested. As Jessica's portfolio grew, these quarterly dividend payments became a substantial source of tax-free income. By the time she reached retirement, she could potentially live off just the dividend income without ever touching her principal, and every penny of it would be tax-free. As Jessica became more sophisticated in her investing, she added 2 portfolio enhancers that took her strategy to the next level. First was the small cap ETF, her opportunity hunter. The small cap space offers some incredible opportunities for those willing to hunt for hidden gems. You've got VBR, which focuses on small cap value stocks, AVDV, which targets international small cap value, IJR, which covers the broad small cap market, IWM, which tracks the Russell 2000 Small Cap Index, and VB, which gives you comprehensive small cap exposure. But the small cap ETF Jessica chose was AVUV, the Avanti Small Cap Value ETF. And this choice was brilliant for capturing untapped growth potential. Small cap companies are those with market capitalizations between $250 million and $2 billion. They're the hidden gems that most people overlook. These smaller companies have much more room to grow than large established corporations. A small company can double or triple in size much easier than a giant like Apple or Microsoft. AVUV holds over 700 small-cap stocks spread across a wide variety of sectors, giving Jessica exposure to companies that could be tomorrow's big winners. The performance has been impressive: 19.56% returns over the past 5 years and 12.05% over the last 3 years. The key insight here is that most broad market funds like VTI give you very little exposure to small cap companies because they're weighted by market capitalization. By adding AVUV, Jessica was filling a gap in her portfolio and potentially capturing even higher returns. Of course, with higher growth potential comes higher risk. Small companies can also fail or struggle more than large established ones. But for someone with a long-time horizon like Jessica, this risk was worth taking for the potential reward. The second enhancer Jessica added was the bond ETF, her portfolio stabilizer. When it comes to bond ETFs, you have fantastic options for every strategy and risk tolerance. There's TLT, which focuses on long-term treasury bonds, VGIT, which covers intermediate-term government bonds, SGOV, which provides ultra-short treasury exposure, VGLT, which targets long-term government securities, and GOVT, which gives you broad government bond coverage. But the bond ETF Jessica chose was BND, the Vanguard Total Bond Market Index Fund ETF, and this was the perfect stabilizing force for her portfolio. Now, you might be wondering why Jessica would want bonds in a growth-focused Roth IRA. Here's the thing: bonds serve a crucial purpose in any portfolio. They provide stability and steady income while helping to balance out the volatility of stocks. BND holds 11,380 different government and corporate bonds with a mix of short, intermediate, and long-term maturities. The yield to maturity is 4.7%, providing Jessica with steady income even when the stock market was going through rough patches. Bonds are much less volatile than stocks, so they act as a stabilizing force during market downturns. As Jessica got older and closer to retirement, having this stability became increasingly important. The bond allocation helped smooth out the overall volatility of her portfolio while still providing decent returns. This is especially valuable for someone who might need to start withdrawing money in retirement. You don't want your entire portfolio subject to stock market swings when you need predictable income. Jessica's final secret weapon was the sector ETF, her amplifier for maximum growth. The sector ETF landscape is incredibly diverse, offering targeted exposure to specific industries that could dominate the future. You've got XLK, which covers the technology sector, XLF, which focuses on financials, XLE, which targets energy companies, XLV, which concentrates on healthcare, XLI, which covers industrials, and XLRE, which gives you real estate exposure. But the sector ETF Jessica chose was VGT, the Vanguard Information Technology ETF, and this was her bet on the future of the economy. This fund is concentrated specifically in the technology sector, holding around 319 stocks with heavy positions in companies like Nvidia, Microsoft, Apple, and Broadcom. By adding VGT, Jessica was making a targeted bet on the sector that has driven much of the market's growth over the past decade. The results speak for themselves. VGT has delivered over 570% in total returns over the last 10 years. That's absolutely incredible performance that came from betting on the technology revolution. Jessica recognized that technology wasn't just a trend, it was fundamentally reshaping every aspect of our economy. From artificial intelligence to cloud computing to electric vehicles, tech companies were at the forefront of innovation and growth. However, Jessica also understood that concentrated sector investing comes with significant risk. When tech stocks struggle, a fund like VGT takes the full impact. But for someone with a long investment horizon and a tolerance for volatility, this concentrated exposure to the most dynamic sector of the economy made sense as a small portion of her overall portfolio. Now let me show you exactly how Jessica put this all together into her $1 million strategy. Jessica's complete portfolio was strategically allocated to maximize growth while managing risk. She put 40% of her money into the broad market ETF VTI. This was her foundation, giving her diversified exposure to the entire stock market with steady, reliable returns. Next, she allocated 25% to the growth ETF SCHG. This was her accelerator, focusing on the fastest-growing companies to maximize her long-term returns. 20% went to the dividend ETF FDVV. This was her income stream, providing quarterly tax-free cash flow that would eventually help fund her retirement. She split 10% between the small cap ETF AVUV and the bond ETF BND. The small cap exposure gave her access to higher growth potential from smaller companies, while the bonds provided stability and income. Finally, she put 5% into the sector ETF VGT for concentrated exposure to the technology sector's explosive growth. This allocation worked perfectly for Jessica because she was young when she started and had decades for her money to compound. But here's the key. She adjusted this allocation as she got older. In her 20s and 30s, she was heavier on growth and had no bonds. In her 40s and 50s, she started adding more bonds and dividend stocks. By her 60s, she had shifted to a more conservative allocation that prioritized income and stability over pure growth. Throughout her entire investing journey, Jessica used dollar-cost averaging, investing the same amount every month regardless of what the market was doing. This strategy helped her buy more shares when prices were low and fewer shares when prices were high, ultimately lowering her average cost per share over time. Jessica's $1 million Roth IRA didn't happen overnight. It was the result of consistent investing over decades, letting the power of compound growth and tax-free returns work their magic. Which ETF type excited you most? Let me know in the comments below. And if you want more tax-free wealth strategies like this, make sure to hit that subscribe button and ring the notification bell so you never miss a video that could change your financial future. This video is for educational and informational purposes only. Investment performance shown is based on historical data and projections. Past performance doesn't guarantee future results. Always conduct your own research and consult with a qualified financial advisor before making any investment decisions. Thanks for watching.